Good morning. Welcome to the morning market briefing. Today is Friday, January 16th, 2026. I hope you're doing well. There will be no show on Monday, but we have plenty of content today, and then we'll have plenty of content Tuesday through Friday next week because there's a lot of news coming out. Earnings season is really ramping into full gear, and President Trump speaks at the World Economic Forum in Davos. But today we're going to talk about some industry news, healthcare, tech, freight. We're going to give you a little bit more preview of the week ahead. Maybe we get an announcement on tariffs today, but we're going to start off, Tom, with a question that we've been getting from a lot of clients and a question that other money managers, including BlackRock, have been getting from big-time institutional clients. A lot of corporations with money that's been sitting in money market funds, earning, well over 5% there for a good period of time, then well over 4%, then 4%, then 375, then 350, and now 330. And it seems like it's only going to go one way. And if we're right about inflation, then those yields and Hassett or Warsh or Reader, one of them is going to get the Fed chair job. Rates are going to go lower on the short end, which means money market yields are going to go lower, which means high yield savings account yields are going to go lower. And what that does is that puts us back into a little bit more of a situation like we had in the 2010s, where there was a trade called the TINA trade. There is no alternative. We're in a very different situation here today because when that trade was going on, rates were literally zero. Today, they're 3.3%. You're still getting a little bit of a spread over inflation, but that might not last for a very long period of time. And so we're getting questions from clients, and we're actively thinking about this as well. How do you continue to maintain yield on that piece of the portfolio that may be a rainy day savings account, may just be ballast for the portfolio? Are there avenues where you can get a little bit more yield without taking an immense more risk?
It's a difficult question because on one hand, 3.5%, historically speaking, at least in our careers, is a lot. It doesn't sound like much, and some of it's a little bit of anchoring to the 5. I mean, it's almost like when you watch Bar Rescue, it makes more sense to price a meal at $9.99 than at $10 because it feels like less, and so it would incentivize more buying. I think the way I would attack it, and I mean this is very much the way I do it, is any money you need within that month, just your operating cash, needs to be in your bank account. Call it $3,000, $5,000, $10,000, whatever you feel comfortable with, your monthly outflows have got to be in your bank account. And if you're at a major bank, you're going to basically get zero. I mean, I use USAA, they're lauded for their car insurance and their service, but they don't pay squat on savings accounts. I mean, I think it's 10 basis points, even now. Outside of that, if you need it within the next 6 months, I think money market's still a very good option. But there are a lot of people who are sitting on a lot of cash. We've talked about the somewhere between $7 and $9 trillion that's sitting in money markets that's slowly making less and less. I think there are a lot of options, but the problem is you're going to have to take a little bit of volatility. Not a lot, but some. And I think the way I would attack it is having some very liquid short-term fixed income investments. And we talk a lot about the benefits of owning individual bonds. I mean, you can still buy treasuries out to June where you can get 364, which is going to get, call it 25 to 30 basis points above even the best money markets. You could do that, have a little bit of that, say, hey, 360 is better than 350 or 330 on your money market. I can get out of it at the drop of a hat. I'm not going to take any losses there. It's going to slowly march up towards par. But I think there's some interesting options. I mean, things like short-term CLO ETFs, we've been using a lot. They pretty much stay very stable. There's some volatility when you hear things like the First Brands drama. People are worried that CLO funds are going to get popped, but as long as you stay in the AAA tranches, you're going to be pretty insulated from that. You're getting between 5.5% and 6% there. They're daily liquid, even when the bond market is closed, which is nice. If you want to get pretty squirrely, we do own a closed-end fund that I like very much, which is the FTHY is the ticker, Frank Tango Henry Yankee. It basically fluctuates the price fluctuates, but the net asset value, which is the underlying bonds in the account, are worth a lot more because it's a pretty illiquid security. It pays about 1% a month, which is very nice, and it matures in the summer of 2027 at that net asset value. So say right now, I think yesterday it was trading at 14.20-ish, and the net asset value is just shy of $15. I think it's like $14.90. So that's going to close. The difference between the price and the net asset value, which can both fluctuate, but the price is going to fluctuate more in about 18 months. So say you meet in the middle at 14.50, you're going to get, call it 30 cents of upside plus 1% a month in income. And it is a maturing security like a bond, but it is a very unusual and esoteric instrument. But it's going to give you a lot of yield. And if you think, I don't need this money for 18 months, I mean, that's a hell of a place to put it. If you are on board with the boys and you think, I think the long bond's coming down, I think inflation is having its death rattle, and we're probably looking 6-7 months out from being sub 2%, then I'd buy the 30-year bond. You can buy something like UTHY, which is a bond, is an ETF, daily liquid, same as the others, where you're getting the exposure to the 30-year Treasury. You could have a lot of convexity there. And you could maybe see double-digit returns if bonds do come down. If not, you're going to get the rate of the 30-year, which if you bought it today would be 4.82%. And if it just stays flat, that's a nice year, and that's significantly more than you get on a money market. And so, obviously if rates sell off, you're going to see some downside there. If rates come up, you're going to see a lot more upside. So I think there's a lot of different ways you can play it. A mix of those things is how I would attack it. And when we're doing that in portfolios, we're doing it in our own accounts. But I would say, if we see a scenario where inflation does come down quite a bit and unemployment ticks up, we're probably going to see more rate cuts than not. And then very quickly, you're going to be sub 3 on those money markets. And that money's got to go somewhere. But I think that being proactive now is going to be better, because if rates do come down and the long end comes down, that 4.82%, at 4.83 now, ticking up a little bit, is going to be gone. And so, as you know, when you make the money when you buy the bond, not in the future because something moved. And so I think that it's a good question. It's a tough question right now. There are a lot of moving parts in the bond market, but one thing we know for sure is we're probably going to get rate cuts. How many we're going to get remains to be seen. But if we get somebody who's very dovish in there, they start cutting rates, those money markets are going to be sub 2. And that's not a great place to be, especially if, inflation is still a little bit above 2.
Indeed. Tom, that's a great overview. And again, with any of these instruments, again, these are not recommendations per se. These are things that we're actively doing in accounts, and we can change our mind at the drop of a hat. So please, with any of that, read the disclosure that Super Producer Hicks puts up at the end of this video. But with these instruments, you will have more daily price volatility than you will with money market funds. And I think that is something that you have to be aware of if you do any of these strategies. And if you say, I do not want to have a drawdown on any day. I'm not saying these are going to go down massively, but you could have a 2, 3, 4% decrease in price in some of these. That's something you just have to be aware of. But in exchange, you're getting the higher yield than you would in the money market fund.
Yeah, I would say if you have questions, you're sitting on a ton of cash, we're happy to point you in the right direction. We can do it. We can tell you how to do it, but be happy to have those discussions. But a lot of clients are asking.
In industry news, Tom, again, Trump is doing his big affordability push right now. He's speaking, especially on the housing market in Davos at his keynote on Wednesday. But yesterday he came out with the Great American Health Care Plan. And I really didn't think that there was much new in this. I was definitely thinking there might be some more crackdowns on upcoding on the Medicare side with health insurers. But instead, it was a lot of recycled talking points that we've already heard. It seemed a little bit rushed together. First is lower drug prices. He talked about slashing prescription drug prices using most favored nation. He's already talked about that. That's already kind of in the works. Allowing more over-the-counter medicines. I think this is interesting. You're going to need a lot of cooperation from the FDA. I don't think it's actually going to significantly lower prices, but what I do think it will do is increase the microdosing community. When you can get your microdosed Ozempic or microdosed any prescription drug,
metformin, all of the bro science drugs.
That's going to help to offset some of the declines in the pharmacy benefit managers, because they're going to sell a lot more pharmaceuticals at the over the counter. Lower insurance premiums. He's looking to go after the big insurance companies by sending the money directly to the American people. He's talked about that. That's going to be tough to get through. He announced a cost-sharing reduction program, but that's basically like the ACA subsidies that existed before. So nothing new there. Cut kickback costs to the middlemen pharmaceutical benefit managers, the PBMs. But again, that's already been discussed.
Everybody talks about that. Mark Cuban talks about it all day long. I'll believe it when I see it.
Right. And the last piece is holding, quote, big insurance companies accountable. And this is just not going to have any impact. Create a plain English insurance standard. Disclose the public cost of overhead versus actual claim payments, and then display claim denial rates. It's supposed to foster more transparency in the insurance industry, but the reality is we've seen these big transparency pushes in corporate America, and it just never ends up coming out the way that you would think. There's a way to massage any statistic or any ratio, and you bet your bottom dollar the insurance companies will do that.
I mean, it's a frustrating thing because obviously they're trying to attack it from a legislative standpoint. I mean, you've got Luigi attacking it from a disgruntled person standpoint, but ultimately, I don't know that there's a way. It's an undefeatable beast.
Short of strong arming insurance companies with withholding like Medicare funds or.
I mean, you've got to eventually. Really I feel like you've got to almost break it up. Mm-hmm. Do an antitrust move and say, you got to split these things up. They've got to be separate. The Bells, create the Baby Bells, the Rockefellers, Standard Oil. I mean, you've got to do something to break it up. I mean, it has to be extreme. And if you look back historically, that worked for a while, and then eventually all the Bells came back together and became AT&T and then merged with SBC Global, and it's just one massive company again. But I think that ultimately people benefit from that. I mean,
if you look at Standard Oil, Standard Oil was a monopoly at one point, making really big margins, and now oil is a commodity.
I mean, you could argue that telephone service is a commodity now too. Both those industries kind of suck. They become dividend plays, and that's kind of it. Stability plays. I mean, ExxonMobil for a time was the largest company in the world, but that was driven by commodity prices, really, not by the fact that they operated at a high level. Not the same way that NVIDIA has become the biggest company in the world. So I think that there's probably something to that. If you could commoditize the price of healthcare, that would be huge. And so maybe that's the move. Maybe the move is just to bust these companies up. I mean, we do a lot of talk about going after Google and Amazon, all these tech companies. They can't have these monopolies. Microsoft famously attacked by antitrust, but why can't we do it to the healthcare? My guess would be because they pay everybody. Mm-hmm. The news isn't going to go after them. Who's going to advertise on CBS?
Right. And you mentioned NVIDIA. Tech did get some investment yesterday. Taiwan is going to invest $250 billion in the U.S. and primarily in semiconductor manufacturing facilities. And in exchange, they're getting a tariff cut from 25 to 15%. We alluded to this yesterday, but now it's been finalized. And then in freight, J.B. Hunt reported earnings last night. They've really been up. A lot of freight companies have been up a lot over the last few weeks. There's this thought that pricing in trucking, in over-the-road trucking, is improving pretty nicely because there's been a lot of capacity that's been taken out of the system. And so that's helping. But on the demand side, they frequently discuss demand as okay, with some maybe better than expected most recent 2 weeks. But you really can't make anything of the most recent 2 weeks in terms of providing guidance for the year. So that's what's going on with JB Hunt. The stock's down about 4 or 5% this morning. I really didn't see anything in the actual numbers to get me excited. And they've tried to call the bottom a number of times. And at the end of the day, they've just kind of admitted that there was a massive trucking bubble in 21 and 22, and that's all kind of been deflated. Not that we had an up cycle and now we're a down cycle and we're going to get an up cycle. More so, we had a cycle and then there was a bubble and that bubble popped and we're back to where we started. So that's kind of what's going on with JB Hunt. That's the flavor that they're giving us. I don't know if we're going to get an announcement on tariffs today. I thought we were going to get an announcement on tariffs last week. If they did it today, I think it would make some sense going into a long weekend. The Trump administration, for its part, says that they can immediately slap on additional tariffs and under another authority. So I'm curious to see the market reaction when and if we do get that ruling. But we should be getting that here in the next few weeks, if not today. That would come out around 10 a.m. today if it did come out. And then so next week we're looking ahead, and Monday we have Martin Luther King Day. We do get a revision on GDP on Thursday, but that's for Q3, so that really doesn't mean anything. And then we have a few companies reporting earnings, including 3M, Netflix, which has been all in the news with its acquisition of Warner Brothers, as well as Johnson & Johnson, Procter & Gamble, and Abbott. Interestingly, also, Capital One on Thursday evening will be the first major credit card-focused company to issue their earnings, and I'm curious if they have anything to say about the credit card interest cap.
And they're going to be one that's really hurt by that.
Yes.
So very interesting. I think it's going to be a big week. Tune in, subscribe, tell a friend. We'll see you.
Like
it, I guess. I don't know if likes really do anything. Likes do anything, Hicks? Big nod there. So tune in. We'll see you guys Tuesday.
All right. Bye.